Before we get started with investing for beginners in earnest, let me make a mild recommendation. Relax. The field of investing is vast, and there's practically an endless amount to learn about investment. The best and most successful investors will tell you that they are constantly learning, polishing, and expanding their talents in the financial market. Hello everyone, and welcome to a brand new video on the channel. Today, we're going to talk about investing for beginners and how to start growing your wealth. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 6. Investment apps. One such service is Acorns, which automatically rounds up your purchases made using debit or credit cards that are linked to your account and invests the difference in a diverse portfolio of exchange-traded funds. To achieve that goal, it manages your portfolio just like a robot financial advisor would, saving you the trouble. There is no minimum required to register an Acorns account, and the service will begin investing on your behalf after you have accumulated at least $5 in roundups from your debit and credit card transactions. You can also make lump sum deposits. Another software option is Stash, which guides novice investors through the process of constructing their own portfolios by using exchange-traded funds and individual stocks. In addition, Stash provides a managed portfolio option. Number 5. Exchange-traded funds. The following are some of the ways in which exchange-traded funds and index funds operate similarly. They typically follow the performance of a market index and employ a passive investment strategy. Also, they typically have cheaper fees than mutual funds do. You can buy an exchange-traded fund that follows a market index, such as the Standard & Poor's 500, just like you would buy an index fund. The primary distinction between exchange-traded funds and index funds is that exchange-traded funds do not require a minimum investment and are instead traded continuously throughout the business day. Investors purchase exchange-traded funds at a share price, which, similar to the price of a stock, can go up or down. This share price is effectively the exchange-traded fund's minimum investment requirement, and depending on the fund, it can range anywhere from less than $100 to $300 or even more. In the past, brokers would charge a commission to acquire or sell exchange-traded funds because they're traded similarly to stocks. If you intend to make frequent investments in an exchange-traded fund, as many other investors do, by setting up automatic investments once a month or once a week, you should select a commission-free exchange-traded funds so that you won't have to pay a commission each time you make an investment. Number 4. Index funds. Index funds are similar to mutual funds, but they're managed automatically. Index funds are a type of mutual fund that follow the performance of a market index rather than hiring a professional manager to construct and oversee the fund's portfolio of investment. A group of investments chosen to be representative of a segment of the market is what is known as a market index. One example of a market index is the Standard & Poor's 500, which compiles the stock prices of around 500 of the most important corporations in the United States. By purchasing the equities that make up the Standard & Poor's 500 index, the goal of a Standard & Poor's 500 index fund is to produce results that are identical to those of the Standard & Poor's 500. Because index funds take a passive approach to investing by tracking a market index rather than using professional portfolio management, they typically have lower expense ratios than mutual funds do. An expense ratio is a fee that is charged based on the amount that you have invested. Mutual funds are actively managed by a professional portfolio manager. Investors in index funds, however, are purchasing a portion of the market in a single transaction, similar to investors in mutual funds. Index funds may be subject to minimum investment requirements. However, certain brokerage firms such as Fidelity and Charles Schwab provide clients with access to a variety of index funds that do not have such limit. This indicates that you can start investing in an index fund with less than $100. Number 3. A Robo-Advisor. It's possible that you've landed on this page because you need to, so to speak, eat your peas. You are aware that you should make an investment, and you have managed to cobble together a little sum of money in order to do so. Yet you would really just as soon get out of this whole mess and do something else. The good news is that Robo-Advisors make it possible for you to do so, in most cases. These services will use various computer algorithms to manage your investments on your behalf. Robo Advisors normally charge fees ranging from 0.25% to 0.50% of your account balance on an annual basis, and many of them allow you to start an account with no minimum. This is because their overhead expenses are significantly lower than those of human investment managers. Because they often require a very small initial investment and handle the majority of the necessary administrative tasks on the investor's behalf, they are an excellent starting point for those who are new to the world of investing. A robo-advisor will take care of the majority of the work for you, but that doesn't mean you shouldn't keep an eye on your account at all times. After all, it is your money, so you should never let go completely. Robo-advisors can also assist you if you want to learn how to invest, but feel like you need a little help getting started in the field. This is another area where they can be useful. It is helpful to gain an understanding of how the service builds a portfolio as well as the investments that are utilized. Some sites also provide educational information and tools, and others will even let you alter your portfolio to some degree in the event that you decide in the future that you want to explore a little bit. Number 2. Target date mutual funds. They're somewhat analogous to the robo-advisors of yesteryear, despite the fact that they continue to enjoy massive levels of adoption and popularity, particularly in the context of corporate retirement plans. Target date mutual funds are a type of retirement investment that invests on your behalf automatically in the year that you anticipate retiring. First things first, let's take a step back and define what we mean when we talk about mutual funds, a collection of investments in all their essentials. When an investor purchases a share of the fund, they're simultaneously investing in all of the holdings of the fund through a single transaction. The manner in which the fund is invested is normally chosen by a professional manager. However, there is typically some form of overarching theme. For instance, a mutual fund that focuses on investing in U.S. companies is called a U.S. equity fund, also called equities. A target date mutual fund typically invests in a diversified portfolio of stocks and bonds. You might want to consider investing in a target date fund that has the years 2050 or 2050 or 2055 in its name if you anticipate retiring in the next 30 years. While your retirement date is still a ways off, most of the money in that fund will initially be invested in equities because, historically speaking, the returns on stocks have been higher over the course of longer time periods. Following the general rule that you want to take a bit less risk as you get closer to retirement, it will gradually move some of your money into bonds over the course of time. This will happen in accordance with the general guidelines. Number 1. A 401 or other employer retirement plan. If your employer offers a 401k or some other type of retirement plan, you should probably put the majority of your money into that first. This is especially true if your employer will match a portion of the payments you make. This match will provide you with both free money and a return on your investment that is guaranteed. You can begin by donating as little as 1% of each paycheck. However, it is recommended that you seek to contribute at least as much as your company will match in order to maximize your potential rewards. For instance, a common matching plan is for the employer to pay half of the first 6% of an employee's income that the employee contributes. You would have to make an annual contribution equal to 6% of your salary in order to qualify for the full match in that situation. Yet with practice and effort, you can eventually reach that level. If you choose to put money into a 401k, that money will come straight out of your paycheck and be deposited into the account rather than being sent to your bank first. Most 401k contributions are made pre-tax. There are a few 401k plans available today that will automatically invest your money in a target date fund, but you may also have access to alternative investment options. The following is a guide on how to invest in your 401. UK, nobody is exempt from the passage of time, and neither is inflation. Thus, it is essential to put some of your money into investments so that it might grow over time. Investing can seem intimidating if you're just starting out. But if you plan out your strategy with specific objectives and a time frame, you can make the process much simpler. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.